Yeah, I think it'll be really critical more so than what's been printed in the first quarter, because keep in mind this war began sort of the last day of February into March. So this really is not affecting Q1 earnings, at least in the US, and possibly and probably overseas as well. So it'll be really key to see what the outlooks are from these companies. Here at home, we've seen that one of our major recreational vehicles companies have pulled their guidance for the year because of some of the challenging, potential tariff environment. In addition to, the extending of the CUSMA, the old NAFTA agreement. So there's definitely, I think that will be the most important part, to see what visibility companies have for the balance of the year. Now that input costs have gone up quite a bit. Wage inflation is still sticky and high. Obviously, chemical and petrochemical prices are 25% higher. So input costs are higher. Now, somewhat offsetting that, we've seen, certainly some early signs of productivity enhancement due to, new AI tools and things like that. I don't want to get carried away, but there are some different forces sort of buffeting the overall growth and inflation picture that I think could mean that earnings stay pretty resilient. But just whether companies will go out on a limb, they have really an excuse to suggest that, well, they were going to make earnings, but now it's a little bit unsettled, and with a high multiple, as we've seen. Still, I don't think you want to put stick your neck out too far in extrapolating Q1 earnings out on the rest of the year, because of some of those challenges that we had. But honestly, earnings are accelerating relative to the run rate of the last 2 years. A lot of that is technology. A lot of that is these advances that we've seen in chips, and the spending that we've seen from the economy at $600 billion in terms of capex. It is really pushing the economy along, in addition to the one big beautiful bill and some of that tax relief that is helping the consumers. Now,